Hey everybody, so today I'm going to be making this video to talk about a few things that I've been noticing within the stock market, the economy, and just geopolitical news. None of this is financial advice. Please do your own research. Everything I've ever said, anything I will continue to say, and anything I say in this video is not to be construed as financial advice. It's just my humble opinion. I am constantly wrong, and my views are constantly changing as well as new data comes out. But I'm going to be talking about Kevin Warsh, the next Fed chairman, potentially, Chinese stocks and where I see them going, a little bit about the Japanese economy, share some of my views on silver currently going on, where I see interest rates heading, where I see mortgage rates possibly going, and I wanted to talk a little bit about Coupang and what do I think about Stanley Druckenmiller, Scott Bessent, George Soros a little bit, and Kevin Warsh, and a few other things in my mind, and where I see things heading geopolitically and economically. So with that being said, I'm going to start. So I think before I start talking about Kevin Warsh, it's important for me to explain that when I look at the current PE ratios by country, the United States, with its high interest rates and strong dollar, has a really robust stock market that is generally propped up by the AI bubble and tech sector. But if I were the United States, I would want to slowly deflate the tech bubble and AI bubble and move that money into different sectors of the economy, especially as we move towards lower interest rates. And I think that's what the goal of the United States is. We've seen this over and over and over again, where they will have a business or cyclical rotation from one asset, one sector to another, and while doing so, if you want to have stability at the same time, and you want capital and investments and foreign direct investments and investments to move into different parts of the economy, you may want to have a strong Fed to back you as you do these types of things, along with the economics and geopolitical conditions and domestic situation being able to accommodate this transition. And I see that happening. I see a more globalized and interconnected world moving forward. And I think that when we consider Stanley Druckenmiller, Kevin Warsh, George Soros, and Scott Bessent and their relationship, I think it becomes more apparent as we do more research. So I haven't really had the time or energy or even resource to really put a lot of time and effort into doing research, but you just some quick Google researches to kind of put things together, and I'm going to present my idea. So I still think that Chinese stocks are a great deal, and I think that they're going to continue to be a great deal over time. I wonder if Coupang, despite the Korean stock market, the Kospi doing really well, still may offer a high return on investment over time. And I wonder about how Japanese stocks are going to do over time. I mean, they have their purpose, but I wonder if a stronger Japanese bond market can supplement a slower growth towards the Nikkei. So Kevin Warsh is I think Kevin Warsh is the independent board, one of the independent board members in Coupang, the Korean e-commerce platform. It's like the Amazon of Korea. And both Stanley Druckenmiller's firm and Kevin Warsh, who I believe works for Stanley Druckenmiller's firm, both own Coupang stock. So Coupang, if it were to do well, they would both benefit. What I thought was interesting was looking at Stanley Druckenmiller's 13F portfolio, is that it seems to me that he's looking for he might be betting on a world where there's lower interest rates, more global growth, increased liquidity, and a stronger Asian currency. And I think this because when you look at this, a lot of his companies are pharmaceutical companies. And not all of them are from America. Like I think some are in like parts of Europe, parts are in the Middle East, along with the emerging markets ETF. I think this is the emerging market ETF, along with Copang. So he has a lot of different investments here, but yeah, what stood out to me was the emerging markets and Copang, and a lot of these different pharmaceutical and bio and health. Based on the business cycle chart here, if we are based on silver and gold's performance, if we're kind of around here, like a late bull, late bull market near top, then what comes next is healthcare and consumer non-cyclical. So we could see Druckenmiller have a portfolio position to benefit from lower interest rates, more global growth, and a stronger Asia, and along with a weaker dollar, and maybe the Treasury, the Federal Reserve will try to lower rates, but maybe roll off some of their mortgage-backed securities in order to have more ammo to help to maybe buy more treasuries to force lower rates or encourage lower rates over time. So the current 10-year is 4.241, and I don't really know how recent this is, but based on the Federal Reserve's balance sheet as of December, a lot of it is mortgage-backed securities. So if you wanted to reduce mortgage-backed securities, what the Federal Reserve could do is that they could roll off some of the ones that may be expiring in 2025, 2026, especially during COVID, when a lot of the interest rates could be lower on these non-fixed mortgage loans, and that could destabilize and slow down mortgage rates. But at the same time, if the Fed maybe buys more U.S. Treasuries to increase the demand on U.S. Treasuries, they could lower the 10-year yield, increase bond demands, and maybe the 10-year will kind of balance out mortgage-backed securities being rolled off. So you can have the best of both worlds in a sense, where interest rates become lower, the national debt becomes easier to finance, mortgage rates and home prices go down or stabilize or go down or slightly up based on interest rates and the 10-year more than the Fed buying mortgage-backed securities. And this could also allow more room for the Fed to help facilitate lower interest rate environment, help bail out the U.S. economy when maybe there could be some problems or high volatility due to silver prices and gold prices being really volatile. If there are firms that are being punished or maybe they're being short squeezed, or maybe there's something going on at the derivatives market, the Fed can step in and help a lot of these firms, especially as we deleverage from unwind the yen carry trade. The Fed also has more ammo to step in as well. And as we move towards lower interest rates and the yen strengthens and the dollar weakens, there's just going to be a lot of volatility and a lot of hiccups along the way. So the Fed can have more ammo to deal with all these things that pop up as we lower interest rates and other currencies and other economies strengthen versus the dollar. Like if the yuan strengthens and maybe a lot of shorts, like a lot of firms might have been shorting Chinese companies, then maybe you could see a situation where the Fed can step in and help bail out a lot of these companies or firms. If there is arbitrage going on between like the US dollar and yen, maybe the Fed can step in for those who are caught. Or if there's anyone, maybe they're suppressing silver prices, maybe the Fed can help bail out those areas as well. Or maybe if we move towards lower interest rates and there's a huge run out of the AI bubble, rather than that happen, the Fed can facilitate like a gradual deflation of the AI bubble, or at least a slowing down of the growth nominally, or the real value of it deflating as we move money and capital into other parts of the economy and the world. The Fed has more resources to make that a smoother transition. Let's see what we have here. So when we look at PE ratios by country, China still has around 10.84. I think it's like maybe 10 to 14, depending on if you consider the Hong Kong or not, or the Hong Kong markets. But Japan has 17.46. South Korea, I think, was like 16 to 17. But basically, when you look at China, yes, it's true that they're currently going through deflation right now, and they probably could benefit from more inflation. So the European Union, the United States, Canada, Japan, South Korea, they could benefit a lot from China exporting deflation and more capital moving into Chinese assets, because it allows for countries like Japan to import deflation while China can import inflation. And I think that's where we're going to be seeing things head over time. But let me see, what else do I have here. Sorry, it's been a really long day and I just haven't had the time to really put things together. I've just been so busy. But yeah, so as we look here, Japan's inflation rate is maybe around 2.1-ish. So strengthening the yen could lower inflation as well, especially if they attract more foreign direct investments. More capital could inflow in there. Same thing with South Korea. Their inflation is supposedly around 2.3. United States is supposedly, so when you look at these numbers, like the real inflation rate, even if you use like the general formula for calculating inflation, may not be accurate. And the types of inflation we feel may be different from like what governments and institutions are referring to. Inflation rate in China is much lower as well. Below 2, but that is just because there's lower inflation doesn't mean that there is job growth and job stability and economic stability and social stability. Like, just because these countries report low inflation doesn't mean that there are these types of stability. And when you look at the Nikkei, despite the Nikkei doing very well, not all companies have been benefiting from it. Even it's sort of like the United States, where the performance of the Nikkei really helps hold up pensions, just like in the United States. But not all companies have been benefiting from the rise of the S&P 500 or NASDAQ. Same thing with the Nikkei. Like if you look at Nissan Motors, for example, there's a lot of examples in Japan where small caps, medium cap companies haven't been doing as well. So you can have sector rotations within these countries while still propping up the larger industry, the indices, to act as a kind of like a welfare program for the government, or like a welfare program for the state. Maybe have some sort of like general idea of like your tax revenues through the asset markets and things like that. So you can still prop up these financial markets, but have them move into other industries, have them move into companies and stocks that haven't been doing so well, to keep the overall Nikkei up or keep the overall S&P 500 up. Still have its purpose, but move capital from different industries and different companies to help move concentration from these certain assets. So let's see, the small caps have been doing pretty well too, but not nearly as well as the Nikkei. So Let's see here. But anyway, so to talk more about where I see capital moving, if it's true that based off what Druckenmiller have said and some of the little things I've seen with Kevin Warsh, we all know that Federal Reserve Board members, politicians all do insider trading. Not all of them, but a lot of them do. A lot of corruption, a lot of bribery. So if the United States does lower their interest rates, you can still prop up the financial markets and the stock market to act as like a welfare program for a lot of your pensions and your 401ks and things like that. But if you want to reduce real inflation, what you can do is that you can move a lot of the capital from the tech sector into other markets as well, into other sectors as well. And what you can also do is that we could see the United States is already kind of done with like its financial imperialism, where they have a strong dollar, they buy up all these assets globally for cheap, they'll buy stocks, they'll buy like ports, they'll buy bridges, they'll buy canals, they'll buy businesses, all for cheap in these distressed countries where maybe they can't really manage to do well versus a strong dollar. So if they want to acquire a lot of the canals and ports in Latin America or in Asia or different parts of Africa and Europe, they can use firms to acquire a lot of these things through financial imperialism. With a strong dollar, buy up all these commodities, raw materials, stocks, assets, debt, distressed debt. There's all these things for distress at a low cost, mainly because of the United States dollar being so high. And what the United States can do after they've acquired as much assets as possible. And I wonder if Trump invading Venezuela or Trump trying to invade Greenland is kind of showing that we're kind of close to this end where like you can't really do financial imperialism anymore. Well, you still can, but I mean that's what we've been doing, but moving more towards physical imperialism may be like soaking up the last bits of it, and before lower interest rates and acquiring also to support a lower interest rate environment and more global growth environment. Maybe we could see the United States has acquired a lot of these assets already, and now maybe when you lower interest rates, they can benefit from increased global growth, right? So maybe they can capitalize on the asset values of their ports going up as more demand and more usage comes through it. Maybe their stocks and their debts that they've acquired will benefit from lower borrowing costs as well. And eventually, in the long run, the United States will probably raise their interest rates so they can kind of like suck in all the wealth that they've from all the assets that they've acquired for cheap as the dollar's been strong. But yeah, I'm not too certain yet. We're gonna have to see how that goes. And as China's currency goes up, as Chinese currency goes up and Japan's yen goes up as well, and other countries' yen currencies go up as well, they're gonna want to do the same thing, right? They're gonna want to acquire assets for cheap. Even in the United States, they might want to invest in like the Europe, the G7 countries. So if I were China, for example, they could let their yuan strengthen so they can buy raw materials and commodities for cheap, along with acquiring different assets globally for cheap as well. And they could even make more direct investments into the United States and European countries, and along with Global South and all these other countries at a much cheaper cost. And if I were Japan, I would probably consider doing the same as well. I would try to buy raw materials and commodities so my exports can become much more competitive, because maybe it has more pricing power because all these raw materials are much more affordable. And it also strengthens the balance sheets of your companies as well, while attracting foreign direct investments, especially if firms may not want to invest as much in the United States, not because of like political instability which exists, but maybe because of maybe stocks and bonds may not offer that attractive of a return on investment as of right now. So for me personally, if I were a firm and if I own United States stocks, I would be very careful. I would be looking for companies that haven't been benefiting too well from high interest rate environment, companies that would benefit from lower interest rate environment, and I would be looking for companies that didn't do too well but could benefit from more global growth and lower tariffs and in the United States. And I'd also be investing in emerging markets in China as well, where there's still a lot of value and they'll benefit from lower interest rates, more global growth, and a reduction of tariffs. So where do I see China moving forward? I don't really know for sure, but if I were the United States, you could force lockdowns like we saw during the times. I can't say it for sure. I'm not allowed to say it, but you could, as you make these economic and political reformations, it can cause a lot of volatility socially and economically. So it's possible that having more lockdown type situations can make things more efficient and control where capital flows. I'm not saying you should do it, but you could see why. It could be helpful as businesses consolidate, as capital flows move, as you need to promote human labor to move to certain areas and capital and to move into other areas as well. But I'm not saying that's a good way to handle displacement, but I see where it has its place. I mean, if we have a choice between a soft landing, or not soft landing, but stability through while transitioning, or an economic crisis or recession or depression, if you can control where things go, that would be great. But let's just pretend we can't do that. Then, it's possible that maybe tariffs could be lowered once interest rates are lowered. So even if the United States lowers interest rates, which would cause inflation, if you have Chinese foreign direct investments going to the United States, if you reduce tariffs, but it's under the condition that China and a lot of the international community buy U.S. bonds, buy foreign direct investments into the United States, buy more of the United States exports to make them more competitive in certain industries, along with more joint ventures. If you do lower interest rates and you do lower tariffs at the same time, then you could have a sweet spot eventually over time where there's more free trade-ish and there's lower interest rates and there's more global growth. And the United States can benefit from all the assets that it's probably acquired while the dollar was strong. So, we could see a situation where tariffs are lowered really soon, probably in the next year or two. We could see interest rates lower as well. But, what we learned from 2020 was that, at least how I saw it, was that a lot of the Chinese electric vehicle companies benefited, just like many companies in emerging markets, they benefited from lower interest rates and higher global growth. And what the lockdowns did was that it really helped economic controls, along with capital flows, move into certain areas where there's probably more productivity and more efficiency. So if you were to, if you were China, for example, and you can build a world away from the United States, but you shouldn't, because then that could lead towards more problems in the long run. If you can't contain economic crises within the United States, or geopolitical or social ones, like they might move towards more military imperialism if you don't bail out the United States or help them, then what China can do is that they can still own the means of production, but they can absorb their stock market and asset markets can soak up a lot of the inflation created through the wealth effect by having United States assets so highly valued and overvalued. You can move some of those the capital as lower interest rates lower. You can promote a lot of money from the money market into Chinese firms, and you can have a global capital rotation from the United States into Asia region and Africa and developing emerging markets to soak up a lot of that liquidity. And you can help promote global growth through paper values along with real physical assets as well. So that's what I would do for the United States. I would try to make a deal with China to bring their companies over in joint ventures. And it doesn't matter because the United States can't steal any patents from China. And even if they did, they can't mimic it because China offers things that the United States can't have, like low labor costs, large amounts of highly skilled workers, efficient supply chains and logistics, a whole ecosystem of raw materials and commodities and supply chains. And these things aren't things that the United States can replicate, even if they could make a Neo battery swap station, or for example. So what they should do instead is when you consider Tesla, for example, I'm sure that the Tesla factories in Shanghai have much higher profit margins than any of the ones in the United States. But you can bring like Neo factories over, or a BYD factory or a battery factory to the United States to provide higher skilled jobs, and you can increase global demand by doing so. And as global demand grows, as different countries develop as well, and the supply chains become revitalized and there's more capital flowing, so more borrowing costs become cheaper, investing grows, more economic activity, then the demand side will grow as well. So yeah, again, Tesla factories may not make as profitable vehicles in America, but on the financial statements of these companies when they're reporting earnings, the net profit margin and the net profit growth and net revenue growth is all that people really probably care about. So, you're kind of giving up some of your factories or moving some more factories, not giving up factories, but you're moving factories. Maybe you'll have like 3 Neo factories in the United States and you'll have a couple in China, but you'll have access to Western markets that, when the Western G7 countries or the Western bloc enacts tariffs or sanctions or trade barriers, you can encourage them to open up their markets if you share in the amount of job opportunities available and global growth. And so, do I think that the United States is in a position where they should lower interest rates? If they acquired a lot of assets globally while they had the strong dollar, if they choose to move money away from their tech and AI bubble into other parts of the economy and stock market and asset markets that have been doing so well, if China wants a stronger yuan along with Asia, and they can soak up some of the inflation from the United States, and China doesn't mind exporting deflation, and they want to increase their net profit margin, and China's in a position where they can maybe take on more inflation, which maybe could help their property sector, or it could help their debts, it could help them with their own problems as well, it could give them more room to cut interest rates as well, then maybe we could see a position where everyone benefits from global growth. And that's where I see things going. And when I look at Druckenmiller's portfolio, Coupang, emerging markets, this is a portfolio to me that looks like it's betting on more global growth, lower interest rates, and increased global liquidity. So yeah, that's where I see things going. So I think that as we move towards that, I wondered about the silver market. I mean, did the silver markets and commodity market and China restricting rare earth metals and having like a silver export ban or a silver export limit, did all these types of small things here and there indicate that the world wanted lower interest rates and increase global productivity again? Was the world getting tired of being asset stripped by the United States? Russia may not be able to do the same financial colonialism or imperialism that the United States does. So maybe, maybe they have to actually do physical invasions. I'm not saying that. I'm not saying that. I'm just saying, though. I'm just saying. Just kidding. But look, and there's many ways to look at that, right, of what Russia did. But, I'm just saying, like, if you can't do it through financial imperialism by having a strong currency and forcing other countries to trade in that currency and use that currency so you can buy assets for cheap and, use like some kind of like not usury, but, you're making these countries debt distressed and you're making these countries stressed out financially and volatile so you can buy their assets for cheap. Is the United States almost done with that? Are countries getting tired of it? Is the world trying to force lower interest rates through numerous means? And there could be a time where I see that China should probably step in and buy up a lot of soak up a lot of the inflation. It could help them domestically, but I would wonder if they can manage that. I mean, China's a big place, but there is a lot of wealth inequality there, just like in a lot of countries, but in China in particular, there's a lot of very wealthy people in China, but then there's also a lot of people who aren't doing so well either. Like, I think they still have high amounts of wealth inequality. So yeah, we'll have to see if China is in the position to handle more inflation and if they want a bull market run the stock market. I mean, I think so, in some sectors and in some ways if it's managed right. But would they want something like the United States? If global growth works out well and more people move out of poverty and urbanization grows, then maybe, right? So I am still very bullish on emerging markets in China, and I see a lot of investment opportunities here, and I see a lot of opportunities in the United States as interest rates lower. And I think if Druckenmiller, if his current portfolio is accurate, then yeah, it looks like it's positioned for global growth, emerging markets, and increased liquidity globally and lower interest rates. So, and a lot of pharmaceuticals. So maybe we do see a situation where we are in a late bull market near a top. And just because this economic cycle is just because the United States can be through showing signs of a late bull market, this doesn't necessarily reflect China's current stage in their stock market cycle. Actually, I think that China could be in an early bull market as well, and they could just be on different phases of the business cycle. So yeah, with that being said, I hope you have a great day. Thank you very much. Now, this is financial advice. Please do your own research. And I apologize for not having videos that are structured. I've been really busy. I don't have the time or resources to really do as much research as I'd like and put things together. But, I think maybe I'll find some time to put my thoughts together, and I'll try to sort things out a little bit better. But yeah, thank you. Hope you have a great day. Thank you very much. Now, this is financial advice.